Hi, this is Jason, Chief Technical Analyst with Toro Alerts with your weekly market recap for the week of August 8th. We had a really good week in the markets, both crypto and the stock market moving to the upside. So let's dive into the charts and take a look at what we're seeing. Starting out with Bitcoin, take a look at our Bitcoin chart. We're sitting at about 24,500 and a nice up channel since about the middle of June. And as long as we're above this channel line here, it's looking really good that we're potentially heading maybe as high as 30,000 on Bitcoin. That would be probably a pretty major target. I'll be looking for possible correction from there if we can get up to that level. We do need to get above the anchored VWAP level, which is sitting right around 25.5 at the moment. So if we can clear that, then it looks like the all clear sign is up towards 30,000 if we can get above those levels. And as long as Bitcoin's moving to the upside, a lot of altcoin trades are looking really good, as well as Ethereum. So let's take a look at the Ethereum chart. We've been in this one for a little while now, also in a nice upward channel trend here, and we are pushing up against about 2135, which is a resistance level we'll be watching closely. We'll also be watching that 200-day moving average, as well as the Fibonacci extension level at about 2450 on Ethereum. So if we see a rollover in price from any of those levels, I'll probably be looking to take profits on Ethereum. But if we do see price action move up to the upside from there, then we'll probably continue to stay in on that trade. And then jumping over to the markets, we're taking a look at the S&P 500, the SPY chart. We did break above a key level at 425.85, which was acting as resistance, and we pushed through that on Friday. So we are getting fast approaching the 200-day moving average, which is sitting currently at about 431.50. So we'll be watching the 200-day moving average really closely on the three major indices, and keeping a close eye on that to see if there is a rollover from the price action at those levels. But if we see a move to the upside above that 200-day moving average, that'll be pretty bullish, I think, for the markets. And when we take a look at the triple Qs, we got a little bit more room to go till we hit the 200-day moving average. That'll likely be right around 341 on the triple Qs. I think that's a pretty logical spot to look for a potential rollover. But if we do see it push up above those levels, then I think that'd be pretty bullish for the NASDAQ. And then when we take a look at our Dow Jones Industrial averages, we are actually much closer to the 200-day moving average, just a few points below it right now. So I'd imagine we'll probably see a resolution to this going into next week. And if we do see a move above that level, we've got to clear 342.30 to get above the next Fibonacci extension level. And if we can get above both the 200-day and that Fibonacci extension level, things will be looking pretty bullish for the Dow Jones Industrial averages if we get a move above those levels. Taking a look at the Dow Jones Transportation Average Index, we did get a move above our 1.618 extension 2 weeks ago, and we closed above that. And then this week we saw a nice move to the upside, which also got above the 50-week moving average. So things are looking pretty solid in the transportation index right now. And when we take a look at our Russell 3000 chart, we are getting up against the 50-week moving average, just a little bit more to the upside to reach that level. We'll be watching that one closely to see if there's a price action rollover from there. But if we do see the price action move up above that 50-week moving average, that'd be pretty bullish for the markets abroad. When we take a look at our Russell 1000 chart, the large caps, we did get a nice move above this Fibonacci extension level we were talking about the previous week, where we did see some resistance against it, but we moved quite nicely above it this week, and now we're getting up against the 50-day moving average, or 50-week moving average rather, likely going into this next week. And so we'll be looking for what the price to see what the price action does at that 50-week moving average level. If we can see it move above that 50-week moving average, I think that'll be pretty bullish for large caps. And then diving into the IWM, the Russell 2000 chart, our small caps, we are getting close up against the 50-week moving average on that one as well, sitting at about 204.50. So if we see a move above those levels, that'll be pretty bullish. But I'm watching these 50-week moving averages as well as the 200-day moving averages on a lot of these charts as some real key levels to keep a close eye on. So if we see a rollover across the board on that, then that may signal the end of this rally. But if we can see some definitive moves above those levels, I think it'll be pretty bullish for the markets. And then when we take a look at our growth versus value chart, we've seen a pretty steady improvement in growth since about the middle or end of May, and we've seen a nice move to the upside as far in relative terms for growth over value. So growth has been outperforming here for the last few months. And then we take a look at our RRG chart, last 10 trading days, the last 2 weeks of trading. Take a look at our sectors that we watch to see which ones are outperforming the best and which ones are underperforming. the most. And at the top of this list here, we've got cloud computing as the clear leader with about 18.5% upside in the last 2 weeks. We saw art, fintech, innovation do really well with about 18%. Clean energy and solars continue to do really well. A lot of that's driven by the new clean energy infrastructure, or the clean energy bill that's been passed. It's putting a lot of money into that sector, and so I think we'll potentially see continued bullish momentum in those spaces. We've also seen some bullish moves out of online retail, traditional retail, as well as biotech. And then at the bottom of our list here, we're seeing natural gas at the bottom is the only sector we're tracking here that's actually in the negative, down about 4.5%. And then some of the other laggards are energy, healthcare, oil and gas exploration, emerging markets, and consumer staples. So a lot of these are more on the defensive side of things, and I think that's a pretty good look for the markets if the defensive sectors are the laggards in this case, and all the risk-on sectors are really moving to the upside. So pretty good looking across the sectors for the markets right now. And then we jump over to the U.S. oil chart. We're kind of sitting in limbo here. We want to see a clear break either above this 50-week moving average or a break down below this channel line to determine kind of the next direction for oil. Oil's been fairly bearish since about early June, and it's been great at the gas pump, but it's been not so great for the energy trade. And so we'll really need to see a decisive break one way or the other in this U.S. oil chart before we kind of figure out where oil's heading from here, and more broadly the energy sector. So if we see a big move to the upside above that 50-week moving average and it maintains above this channel line, then I'd say it'd be pretty bullish for oil, and there might be some nice energy trades developing. But if we see a breakdown below this channel, which hasn't happened since going all the way back down to the COVID lows back in April of 2020, I think that'd be a pretty strong signal that maybe the oil trade is kind of dying out, and that oil might be heading lower from here. So we'll have to keep an eye on that one, see how it develops over the next week or two. And then we take a look at our commodity index. The CRB index had a real strong move up to the upside this last week, but the previous week we moved to the downside pretty strongly. The week before that was a big move to the upside. So a lot of kind of volatility and indecision in the commodity space right now. We need to kind of see a clear break either below, call it about 279 on the CRB, or a clear break above about 296, 297 before we really kind of see what direction the commodity space is heading next. And then taking a look at our consumer discretionary versus consumer staples, we've seen a clear trend change over the last 4 or 5 weeks to the upside in consumer discretionary, which is more risk-on sector, versus consumer staples being more defensive. And so that's been a pretty good signal for the markets, as we've seen a nice rally during that time period. And as long as we continue to see consumer discretionary outperform consumer staples, that should be a pretty good sign for the markets. And then when we take a look at our VEU, the All World ex-US Index, this chart has found a bottom right around early July, and it's been moving to the upside. But when we look at it on relative terms, the story is still similar as to previous weeks. While we've seen some decent performance in the global markets on relative terms compared to the S&P 500, it's been a pretty clear downtrend in that space. And then taking a look at our high yield corporate bond ETF, we came up against resistance at 79.50, a key level that's acted both as support and resistance in the past. And so we'll want to see where we go from here. If we see the high yield corporate bond move up above that 79.50, I think that'll be good news for the overall health of the markets, and likely see it continue in this rally. But if we see a rollover from here at the HYG right around 79.50, then that might be telling us that this rally might be dying off. We'll have to keep a close eye on that. And then when we look at the high yield corporate bond in relative terms to traditional bonds, we're also seeing a really nice improvement there. We're back in this kind of sideways price action that we've been in for quite some time, other than a brief dip below it, going all the way back into about early 2021. So if we saw a clear break above this level at about 0.77, that'd obviously be really bullish for the markets. But I think as long as we're still chopping around in this range between 0.73 and 0.77, then I think things are looking relatively good for the markets, and we'll probably be fine. If we do see a break below that 0.73 level, that'll probably be a concern and warning us that the markets might be rolling over. And then gold and silver have been doing really well over the last few weeks. We saw a pretty bearish move out of both gold and silver for quite a while. Many weeks where it was just heading to the downside. We did get close to the 200-week moving average on gold, had a bounce off of that, just above that level, right around 157.20, and we've had a really nice bounce off of that, going up to about 167.87 to close the week out. As long as the interest rates are going sideways or down on the 10-year, that's typically a pretty good sign for gold. So that's something I'll be watching on the 10-year to get an indicator as to what we should be doing as far as trading gold or not. And so far things have been looking fairly good for the last 3 or 4 weeks in the gold space. Silver as well, about the last 3 weeks has been pretty good. We just got up against the 200-week moving average. Looks like we kind of just stopped right about at that level, so we'll want to see next week if we can see a push to the upside above that 200-week moving average. I think that'd be pretty bullish for silver if we can get above those levels. And then take a look at our interest rates. 2-year interest rates closed the week at about 3.25%. We did see a bit of a sell-off from the previous week, but a lot of that sell-off recovered and ultimately ended up finishing the week out at about 3.25%. And then our 10-year interest rates as well. Pretty big sell-off on the week, but it ultimately ended up basically about where we closed in the previous week. And so there was a bit of a downward movement in interest rates, but a lot of that did recover to the upside. So we'll want to keep a close eye on that. If we see interest rates continue to move to the upside, that could be some bad news for the gold markets, as they've been rallying pretty nicely as the 10-year's been going down. So we'll want to keep a close eye on that if you're trading the gold space. And then our 30-year rate closed the week out at about 3.11%. Did move to the upside on the week, and it did have a bit of volatility throughout the week. It was anywhere from about 2.9 to looks like about 3.2, ultimately closing just slightly higher at about 3.11% in the 30-year. And then we look at our yield curve. We are sitting still very low on the yield curve, sitting at about negative 0.416%. That negative 4.78% is a very extreme level. We've only seen a few times over multiple decades, and so I think this chart here is telling us that we're probably not out of the woods yet. We likely have more pain ahead in the markets, but right now, in the short term at least, things have been looking pretty good. But we want to keep a close eye on that yield curve because it's been in the negative for quite a while, and that tends to give us a pretty strong signal that there's potentially trouble ahead. But looking at it more recently, we're looking at a VIX below 20 for the first time since April. We've been down there really for the last couple of weeks there, just kind of hanging out right around the 20 level. We closed the week at our lowest level here since April at about 19.5. So we want to see where we head from there. If we continue to stay below 20, I think that'd be pretty bullish for the markets. But I think anything really as low as 25 on the VIX is fine. If we see a big spike above 25 or up to 30, I think that would be a big warning signal for the markets, but we're quite a bit below that at the time being. And then our put-call ratios in normal ranges, we're sitting between the 0.5 and 1.0 levels, which we like to see. Anything above 1.0 is elevated put buying protection. And while we did get above that a little bit during the week, it fell back down and closed the week down at about 0.96. And so things are looking fairly normal in the put-call ratio market. And then the last chart we'll go ahead and close it out with is the Dxy chart. I think this is one of the most important charts in the market right now. Typically when the dollar's going up, it's typically a headwind against stocks as well as crypto. And when the dollar's going down, it's typically a tailwind for stocks, and it's typically really bullish for crypto. So if we continue to see the dollar decline as it's been declining, somewhat slowly, but it has definitely been on a bit of a decline since about the middle of July. We'd really like to see a break below about 105, we'll call it. Maybe it's more like 104, 105. We start seeing the DXY head below those levels. I think that'll be even more bullish for crypto space specifically, but also for the markets as well. We're currently just sitting just below the 50-week moving average, and we did close for about 2 weeks now below this channel line that's been in place for quite some time. So if we stay below those levels and ideally see a drop in the dollar below that 104, 105 level, I think that'll be pretty bullish for the markets as well as crypto. Thanks for tuning in this week. Make sure to download the Toro Alerts app on the App Store. We've got one for stocks and one for crypto. And make sure to like and share the video, and we'll see you next time.